What if I told you that a simple $4,000 options trade could suddenly turn into $700,000 of stock hitting your account overnight? This isn't clickbait. This is something that actually happened to a trader I know, and it's the second time I've heard such a story. And it's a risk that every option trader should really understand, because one day it might happen to you. So today I'm going to share a real story with you from our trading community. Luckily, the trader didn't lose too much money, but it perfectly illustrates why within our community we have two golden rules around trading spreads. Number one is never hold the spreads into expiration week. And number two is never let the stock get near your short strike. So in this story, one of our members had 10 bull put spreads on Meta, and the stock closed on the Friday just above his short strike. He woke up on Saturday morning to find that he'd been assigned on 1,000 shares of Meta. That's $697,500 worth of stock that he had to hold over the weekend with zero protection because his long put completely expired worthless. So in this video, I'm going to show you exactly what happened and why you need to be aware of it and how you can avoid this situation. Just a quick reminder that everything discussed is for educational purposes only and is general in nature. This was a really good story from one of our members that if you're in the chat room, I'd definitely recommend you check it out. Basically, he had a bull put spread with these strikes, 697.5 and 695, took it basically into expiration, ended up getting assigned on the 697.50 strike, but the 695 strike expired worthless. So I can't remember how many contracts he had, but I think it was quite a lot, 10. So he got assigned on 10 contracts, 10 contracts times 100 per contract times 697.50. Youch, right? So even though he had a risk-defined bull put spread with maybe 5,000 at risk, he got assigned on the short strike. So that's the reason why we don't take spreads all the way to expiration usually, for one. The other reason is we adjust our strikes before they get close to the short strike. We always want to try and avoid assignment risk. Now, it's not the end of the world because he just, he bought the shares, got assigned, and then he just turned around and sold them on the Monday. But, if he got assigned on this and then something happens over the weekend and Meta opens, let's say, down 5%, he's got no protection anymore because these 695 puts have expired. So there's no protection. He could be down 34 grand. And I've heard another story about that. And I posted on the public blog recently about that, another trader who had a similar story. So be aware that this sort of thing can happen. It's the risk that we talk about when we go to our bull put spreads and we talk about, obviously this one isn't as much of a risk because it's a low price stock, but when we're in this position here in between 50 and 45 at expiration, where we might, pin risk, So, we might get assigned on the 50s and these have expired worthless. We've got no protection anymore. And if the stock got gaps down in the morning before we get a chance to sell those shares, you're done for. Some people call it mid-strike risk. So again, two things we can do to try to avoid that scenario. Don't let the stock get anywhere near the short strike. Always adjust or close before it gets there. And that's why we set those alerts at the halfway point. Don't take it into expiration week. So obviously the assignment risk is the highest right at expiration. Amir says, how would interactive brokers handle the assignment? Basically, this one just expires worthless, gets removed from your account on the Saturday. Let's go back to his position. This is the long put, and that just expires, gets taken out of his account. This one gets assigned. The option also gets taken out of his account, but he also gets a buy trade for this much. And yes, obviously you've got to have the margin or the cash for that to buy those shares. So if you don't have that much cash, you're going to get a margin call, right? Which again is not the end of the world because you can sell those shares on the Monday, but you've got that huge, huge risk in the overnight until the market opens and you can sell those shares. Crazy story. And it's the second time I've heard a very similar story. So do not forget this. Be aware that this can happen. And again, let's look at the actual spread. It was 10 contracts, right? So this would be the standard sort of trade that we would look at. Max risk, $4,000, right? But if it gets close to expiration and the stock's here, you've got the risk that something like that could happen. Now you're okay. Good point here, Rajesh. If the stock is down here at 540, both of the options get assigned and the two cancel each other out, and then you just suffer the max loss of 4,200. That scenario is okay. Well, it's not great because you've lost the max loss, which again, you should never do, but it's better than the scenario of getting assigned on $700,000 worth of Meta shares when you thought your max risk was 4,000. So very, very important lesson, and really appreciate that member sharing that story, and a great discussion point. So if you weren't aware of that risk before, now you are. So let's recap some of the key lessons from today's video. Firstly, never let your short strikes go in the money. If you're doing a bull put spread or a bear call spread, always adjust or close well before the stock gets towards that short strike. Number two, definitely don't take spreads into expiration week, particularly if the stock is close to the short strike price. If it's well away from your short strike price, it's pretty fine to leave it alone. But if the stock is getting really close to that short strike, do not take it into expiration week. And the third point is to remember that even though your spread might only have a $4,000 max risk, if you do take it into expiration and you get assigned on the short put, but not the long put, you've got a massive capital outlay and you've got a massive exposure over that weekend, and you'll be a little bit nervous until the market opens on Monday. So definitely try to avoid this situation. I hope you found the video helpful. If you did, give it a like and subscribe, and I'll see you on the next one. Thanks.